started.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Today's episode is sponsored by the award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. Since Zephyr's inception some 30 years ago, Zephyr has been recognized as an industry leader in investment analytics. That status has been built on years of thought-provoking content and research, an unparalleled presentation of analytics that help investment professionals tell their story, and the creation of new analytics that help these same professionals tell their entire story, not just part of it. Through a series of Zephyr StatFact videos, I will help you make sense of some of these investment metrics that are used, or in some cases, maybe not used enough today, in how to use them. Some of you may be very familiar with the Zephyr StatFacts, which was the creation or brainchild of former Zephyr colleague Mark Otto. So I'm going to take these fantastic resources and put them in a video format. As you know, there are a lot of great investment metrics out there for you to use. And in some cases, it can be like alphabet soup, which can make it confusing in determining what metric an investment professional should use, who they should use it for, and in what scenarios should those metrics be used in. Hopefully, this series of StatFact podcasts will help make it easier for you. In this edition, I'm going to focus on another very popular metric that measures a trade-off between risk and return. It's called the Sortino Ratio. Risk-adjusted return statistics, like the Sharpe and Payne ratios, are very popular for numerous reasons. While these return versus risk trade-off statistics have a lot of similarities, they differ in how they define risk, or what measure of risk they use in the calculation. For example, the Sharpe ratio uses standard deviation as the risk measure, while the Trainer ratio uses beta. And finally, the Payne ratio uses the capital preservation statistic, the Zephyr Payne Index, as its measure of risk. Of all the reasons I like using these risk-adjusted metrics, I think the primary reason why I like using these return versus risk trade-off metrics like the Sharpe, Payne, and Sortino ratio is because they're not benchmark relative, meaning the calculations do not include a benchmark return, which allows one to compare very different managers or compare apples to oranges. Whereas statistics like alpha and the Trainer ratio are relative to a benchmark, meaning you should compare similar managers in order for the comparison to be relevant. Using a statistic like the Sortino ratio allows you to compare an equity manager to a fixed income manager to see what one provides the highest amount of return per unit of risk. If you wish, most people probably aren't going to compare an equity manager to a fixed income manager, but by using a Sortino ratio or Sharpe ratio or Payne index or Payne ratio, you can do that. So on to the Sortino ratio. The Sortino ratio is a variation of the Sharpe ratio. The Sortino ratio is a return versus risk trade-off metric that uses downside deviation as its measure of risk, whereas the Sharpe ratio uses standard deviation as its measure of risk. So how is the Sortino ratio useful? The Sortino ratio addresses the shortcoming of using standard deviation as a measure of risk in a return versus risk trade-off ratio. Standard deviation is a fantastic measure of volatility or risk, and arguably the longest used and most widely used measure of volatility. but it punishes a manager equally for good risk and bad risk. Meanwhile, downside deviation adjusts for this by only counting the bad risk and ignoring the good observations in a return series. The Sortino ratio replaces standard deviation with downside deviation. So you can say that Sortino ratio is the added return per unit of bad risk rather than overall risk. So what is a good number? And like most ratios, the higher the Sortino ratio, the better. One would hope to see a substantial excess return above and beyond the risk-free rate, accompanied by little downside deviation. A scenario such as this, where it's higher excess return combined with lower downside deviation, would produce a very large Sortino ratio. It is important to keep in mind the asset class under consideration when analyzing a Sortino ratio. So what are some of the limitations? Since the Sortino ratio uses downside deviation as its measure of risk, any limitations of downside deviation carry over to the Sortino ratio. With downside deviation, there must be enough bad observations in order for the calculation to be statistically significant. If you're measuring managers over a period of time where it's a very long, consistent bull market, there might not be enough bad observations to calculate downside deviation. Another limitation is everyone's interpretation of what bad is different. Some people may think a bad observation is a return anything below zero, while others may think a bad observation might be anything below the risk-free rate. So there's ways to determine what is bad, and the interpretation of bad is different across different people. On what return is that break point for being bad? Is it zero? Is it the risk-free rate? Or maybe just like 3%? What is bad? So some typical values. One would expect to see Sortino ratios change significantly for most asset classes between the 2 decades of the 1980s and 1990s, in the lost decade of the 2000s. And that is the case. The numerator of the Sortino ratio was reduced in the 2000s as many asset classes struggled to outperform the risk-free rate. The denominator was increased as markets exhibited more downside deviations short of that zero break point, or that 0% minimum acceptable return, or MAR. So when to use it? Financial advisors, should use the Sortino ratio when searching for managers for more conservative clients who have capital preservation as an investment objective. Since the Sortino ratio focuses on bad volatility, it is a good metric for investors who want to limit their drawdowns. But it's not just suitable for investors concerned about preserving capital. It is very useful. It's a very useful metric when you want to look at the return versus risk trade-off during periods of time when steep market sell-offs, corrections, or bear markets are likely. And you want to consider for yourself or for the client you're looking to find a manager for, what is risk to you? Is it overall risk, like standard deviation, where it just is a volatility of a return series? Or is market risk or investment risk to you losing money, right? Is that your risk when determining if you should use a Sortino ratio or a Sharpe ratio? For me, I believe investment risk is losing money. I don't necessarily believe that if upside volatility or good risk or good volatility having a manager that is very volatile on the upside isn't necessarily risk, right? That's just part of investing. I personally think risk is more about losing money. That is the primary risk of investing, losing money, right? So for me, I would probably focus more on the Sortino ratio if, my primary concern is losing money, and that is my primary focus or my primary risk statistic. So that concludes this episode of Adjusted for Risk. And I'd like to thank you all for listening and watching. You can also find other StatFact versions of Zephyr's Adjusted for Risk on the Adjusted for Risk YouTube channel and on Spotify. Thank you very much and have a great rest.